and welcome everybody to this session. I hope it will be very stimulating. I think it's going to be very different from the sort of hype you're hearing from the National Venture Capital Association, because again, I'm looking at it from the point of view of seed stage startups, which is where we work and have worked for 40 years. They are the bleeding edge of innovation in the economy, and we all have a stake in making sure that they can continue to prosper. So for those of you who do not know how large the venture capital market is, this slide will tell you we did $166 billion of investment last year, 2020. That was a record. The biggest amount invested prior to that was in the year 2000, which was the internet bubble, which was 100 million and change. And we've already exceeded that record today. As of the third quarter, September 30th, we were up to $239 billion this year. So we are talking about a massive market. And in case you're wondering why this is relevant for all of us, total employment at the end of last year in venture-backed companies was nearly 2.5 million jobs. The annual cash that is injected into the economy just last year, and this is again from that record amount of 166, 80% of it is in wages and salaries and R&D. So that creates a multiplier effect. And finally, the Kauffman Foundation, which is the leading entrepreneurship institution in the world based in Kansas City, has long tracked the number of annual new jobs that are created by ventures, which is 1.5 million, and that's 20% every year of the total of jobs created in the United States. So we all have a stake in keeping this job creation engine going. I want to do a quick look at the structure of venture capital in case some of you may not be familiar with it. The center of the screen is the venture capital fund. That's the blue box. It is a limited partnership. And over there on the right, on the left, we have the venture capital firm. You've heard of some of them: Andreessen Horowitz, Sequoia, Kleiner Perkins, Bessemer, Lightspeed. Those firms may have multiple venture capital funds. Some of them may be very specialized. For example, some may only invest in the internet, as one of Kleiner's funds did. Some may be only a Series A stage or a seed stage, and we're going to talk about that a little later. The main thing, though, is that the red box, the venture capital firm, acts as the general partner of the venture capital fund. And as such, they go out and solicit investors, limited partners, no surprise there for a limited partnership, private and public pension funds, insurance companies, high net worth individuals, family offices, endowments, university endowments primarily, foundations, fund of funds, and sovereign wealth funds are all typical investors in venture capital funds. However, you should know that once they invest, they are passive. It is the general partner of the venture capital firm that manages the fund and makes the venture investments. The black boxes on the bottom, of course, are those new ventures. So that's what the structure of venture capital looks like and has since 1970, when pension funds were first enabled to make alternative investments. So how do those folks in the red box make money? Two ways: management fees, 1% to 2% annually of the committed capital to the venture capital fund. So let's make the arithmetic easy. If you have $1 billion fund, and typically they're 10 years in length, that means every year at 2%, the venture capital firm is making $20 million a year, whether or not the fund makes money. And those fees are taxed as income. The second way is through carried interest. VC firms today get typically 20% carried interest. And again, the fund typically is 10 years long. So when the fund is closed at the end of 10 years, they can claim their carried interest, and that is taxed as a capital gain. Now, there's an interesting story behind carried interest, and it stems from the very first venture capitalists in the United States, which were whaling syndicates in New Bedford and Salem and Greenport and Nantucket. Wealthy people clubbed together to send whaling ships all over the world. And when they came back, the owner and the captain typically got a commission of between 8 and 12% on the cargo carried. But here's the kicker. 1/3 of those whaling voyages never came back. So the way to think about carried interest is that it is the reward for risk. And in case you don't know this, venture capital is very risky indeed. 64% of all venture investments lose money. 18% only make 1 to 3 times the investment. So it is a very small margin of firms. There are 1,962 in the United States now that make the very high returns that you see out on the right-hand side of the chart. Now I want to jump right into the changes in structure that are happening in the venture capital market. This is a chart of the 10-year US Treasury bond rate, starting in 1960 and going through the third quarter of 2020. The 10-year Treasury bond is, of course, the underpinnings of the US mortgage market, the underpinnings of the US capital investment market. It is the world's largest, the most widely traded and the most widely held bond in the entire world. If you look at the left side of the chart, you'll see that there was a bond rate of 4%. That's the return on the bond in 1960. Then we had massive inflation during the 70s. We called it stagflation. And when Paul Volcker took over as the chair of the Federal Reserve in 1980, the bond rate was at 15%. It took him 8 years to drive the bond rate down to 7%. And the bond rate then continued to slide down to about 5% in 2007. Well, we all know what happened after that. In 2008, arrogant, greedy, selfish, money center bankers, too stupid to understand counterparty risk, created a subprime mortgage derivatives Ponzi scheme and brought the global economy to its knees. And thank God, and note that the bond rate plummeted to 2% as a result of that. Thank God for the Federal Reserve. Ben Bernanke, then the chair, stepped in with a new tool called quantitative easing and tried to help stabilize the economy by printing money, basically, and buying up very long-term assets, corporate debt and mortgages, principally. So quantitative easing, didn't do the job, did the job of stabilizing it. And in 2013, in October, Ben Bernanke thought, jobs were coming back, the stock market was coming back, foreclosures had been halted, and the housing market was recovering. And so he announced that he would taper off quantitative easing. Well, this little hump right here between 2013 and 2014, which is a 1-year period of the taper tantrum, Wall Street absolutely howled like stuck pigs, and he stopped it. And he started what we call QE2, quantitative easing 2. And as you can see, it kept the bond rate very low. In fact, Sheila Bair, who is the former chair of the Federal Deposit Insurance Corporation, stated that he basically put a floor under assets and created a no-lose casino with the second wave of quantitative easing. Now, there's a lot of people who disagree with that, but I'm just stating somebody who is very well regarded in the financial markets on the view of what happened when Ben Bernanke tried to cut back quantitative easing. And just so you know, Jay Powell, the current chair, is about to do the same thing. So I want you to think about who has to invest in the 10-year Treasury bond. 401ks, pension plans, university endowments, unions, municipalities that need to build roads and schools and bridges. A lot of people are hurting besides venture capital from the collapse of returns in this long slide in the venture capital, or excuse me, in the market rate. The second structural change that's impacted venture capital was created by our own former Senator, Chris Dodd. He was the chair of the Senate Finance Committee in 2009 and presided over the Dodd-Frank law, which gifted a capital gains tax rate to hedge funds and private equity for carried interest 1 year. Now, it's been bumped up to 3 years. That happened in 2017. But in those 8 years, 2009 to 2017, hedge funds and private equity made massive windfall profits, tax protected at 23.8% capital gains rate, instead of the 40% they should have been paying on growth equity income. Compare that to the venture capital firms. Remember, they have to wait 10 years until their fund closes before they can take capital gains on carried interest. And the problem is Congress kind of lumps these two together. But as we know, there is a massive difference between a risky seed stage startup investment of the type that venture capital makes and a 3-year low risk, late stage pre-IPO investment, which is what we're going to find out private equity and hedge funds are making. Here's what it looks like in blazing color. These charts are from Crunchbase. The one on the left is the total number of US venture funds divided by percentage of size. The one on the right is the total number of US venture capital assets under management, again, divided by the size of the funds, percentage-wise. If you look at the purple bars on the right, those are funds of $500 million or more. And you will see that from 2008 until the end of the chart here is 2018, these huge funds generated by private equity and hedge funds took a massive share of the market, 2/3 of assets under management in 2018. And by the way, I do have the number for 2020, it's 67%. So it's actually gone up a percentage. Now take a look at the blue bars over here on the left. This is the smallest firms in the market. They're from 0 to $25 million in size. And they are, by nature of their size, the ones who invest in seed and Series A rounds, the very riskiest, smallest rounds of venture capital. Now take a look at the right again. Since 2008, you can barely see the blue on that chart. It's on the very bottom. And the reason is very simple. We have fewer seed stage startups. They're virtually invisible here. Here's the returns that private equity and hedge funds are making today. Very few of them invest in Series A. The ones that do, if they get lucky, they get a 30% return. Most of them aren't willing to take a risk by investing for 10 years, however. They're investing up here in Series G. This is the last late stage before an IPO. And right now, this year, the annualized rate of return on those investments is 15.8%. So if you could get a 3-year tax-protected capital gain at 15.8%, I guess you'd take it too. I know I would. And that's what they get. So the impact on the venture capital firms, the red box on our chart, traditional firms, is massive. In 2020 and through the third quarter of 2021, non-traditional funds, that is private equity, hedge funds, family offices, accounted for 77% of total US capital investment. 77% in the last 7 quarters. Fund sizes have exploded. We saw that on the blazing color chart. The average back in 2009 was 122 million. It was 195 million at September 30th of this year. Mega deals. These private equity and hedge funds can put on massive amounts of money into late stage pre-IPO companies to get their capital gains in 3 years. $100 million funds is what they call a mega deal or more. This year, we've had 597 of them, and we aren't even at the end of the year. This market concentration, where fewer firms are making fewer deals, means that very few of the 1,965 venture capital firms, traditional venture capital firms, are able to make follow-on investments, which means that their seed stage investment, the riskiest first investment in startups, is being diluted. And that is a real mess. So here's what it looks like. Some of the firms, traditional firms that I mentioned earlier, are trying to fight back against this. And these are the big established, what we call multi-stage US venture investors at seed rounds. These are counts of rounds. And the lighter bar, the light blue bar, is from 2016 to 2020, which is really the relevant period of this massive PE hedge fund tsunami of cash. The good news is that Andreessen Horowitz has just made a $400 million fund this year, specifically to invest in seed stage. Now, there were multi-stage before that, but now that's a specific seed stage fund. Greylock has made a $500 million fund this year. Khosla Ventures has made a $400 million fund this year. Sequoia Capital has made a $400 million fund this year. And those funds I mentioned are specifically and absolutely seed funds. They will not invest in any other stage of capital. However, those are this year's investments, and the horse is out of the barn. Because if you look right now at dry powder, which again, if you think about a fund, they don't invest all the money they get from those limited partners at once. They invest a little in seed stage and then in Series A and Series B, and hopefully get an IPO or an acquisition when the firm matures. So those added investments after the seed stage are called follow-on rounds. Those are the gray bars here. Those are follow-on rounds of invested capital. The blue bars at the bottom are what are called dry powder. That means of the funds that have been raised, that amount of money remains to be invested in follow-on rounds. Dry powder, term of art. Now, this chart ends in 2019, but I will give you the numbers for 2020. The top number, $528 billion of capital assets under management. And here's the top number, $151 billion of traditional VCs dry powder. However, notice how PE and hedge funds absolutely dominate the game here. They have more than 2 times the amount of dry powder to invest that the traditional VCs do. And that's why I say the horse is about out of the barn right now. And what's it done? Here's the traditional, non-traditional investors, the PE firms and the hedge funds and the family offices. As you can see, these investments are in late stage pre-IPO companies. They create what are called unicorns. This is a venture that has not gone public, that has a $1 billion valuation or greater. Last year, there were 400 of them in the United States. I expect there will be more this year. And now let's take a look at the IPO market itself and show how PEs and hedge funds dominate it. The red blocks are traditional venture capital investments that have gone public. Let's focus on these last 7 quarters. In 2020, these middle ones, 42% of the 431 IPOs that took place last year were venture capital backed. In this year, in these first 3 quarters, 37% are traditional VCs. Now, what are these big gray bars, you might well ask? Well, those are special purpose acquisition companies. They are a legal structure that allows a private company to take another private company public. And that's exactly what private equity and hedge funds have done. And you can see the enormous amount of money that is being raised with these vehicles by the private equity and hedge funds of the world, of the United States. This is all US data. So what has been the impact on seed stage startups of this tsunami of non-traditional money? Through 3rd quarter, the September 30th of this year, the value of all seed rounds was only 3.7% of total invested venture capital. And that's down from 5.2% last year. We still have a quarter to go, but I'm not holding out great hope that we're going to exceed 5%. Ventures stay private longer. They raise those late rounds that make them unicorns. And guess what? The more rounds there are, the more reduction in the equity of the founders. And then here's something else that's at play. Most late rounds carry what are called guarantees. They protect the private equity and the hedge fund investor from a disappointment in the IPO value. So I'll give you an example. Suppose I invest $14 equivalent in your H round just before you go public, and I write a guarantee so that it won't be less than that, or I'll get recompensed. Well, you go public at $10 a share. Hello, you owe me more shares. So if you want to know more about that type of guarantee, I suggest you look on the internet at Square's IPO. It is the poster child for this type of late stage guarantee. The 4th element of impact on seed stage ventures is the private equity exits do not get reinvested in more seed stage rounds. Last year, there was $295 billion in proceeds from US IPOs. 95% of that went to private equity, hedge funds, and other non-traditional investors. Not to the public in the stock market, not to the ventures that had invested in the seed round or the Series A, and not to the founders. And that's a problem. It is the continuing decline of seed stage financing that really worries me. We had 11% last year, and this chart goes from, this is quarterly, goes from 2015 to 2020 3rd quarter. The dark blue bars on the bottom are what we call VC first financings. And typically those are seed stage. So 2 to 5 million was typical, but more like 2 to 10 million these days. You can see those are very, very low. And in fact, for all of 2020, I don't have the 4th quarter on here, but all of 2020, VC first financings were only $5 billion out of $166 billion invested in the United States. So it shows you how absolutely dominant the late stage money has been. And here's another bad news bear slide. Remember those blue guys on the chart in blazing color? they were the $0 to $25 million so-called micro funds. Well, this chart actually shows the $0 to $50 million funds. And whether you take the smaller number or that slightly larger number, the bad news is that those small funds are losing market share. They are just being hammered by the dominance of private equity and hedge funds in the market. And again, these are the guys that invest at seed stage and at Series A because they are very small. Here's another unhappy accident, or not to say accident. It is a result of the PE and hedge fund dominance in the market. If you go back all the way to 2010, 85% of all venture capital seed stage funded companies didn't have revenues. And that makes a lot of sense when you think about it. A startup, let's say they have an angel round of somewhere between $500,000 and $1 million. And maybe they have a minimum viable product. Probably most of their officers are still embedded in day jobs. And if they're lucky, they have a pilot customer, probably not paying them much. So they need that $2 to $5 million or $2 to $10 million of seed money to scale the business. Well, guess what? Last year, 81% of all seed stage funded ventures had revenues. And that is a massive, massive barrier to entry, as you might imagine. And finally, the Kauffman Foundation, again, the leading institution for entrepreneurship in the world, has been tracking US startups for many years. And last year, they reported that opportunity startups were at their lowest level in 25 years. What are opportunity startups? Well, they're people who are employed. Maybe they have a great idea. They've got a team of people. They've got some intellectual property. Maybe they have a little capital to invest. And they create a venture which can generate jobs. It's designed to scale. And that type of opportunity startup was at its lowest level in 25 years, according to the Kauffman Foundation. Now, the bottom line, the orange line, is a thing called necessity startups. And as you'll see, they went in the opposite direction last year. Necessity startups are sort of the flip side. These are people who are unemployed. They have no capital. Typically, these are one-man bands. They are hardships where they've lost their jobs or a spouse has lost their job. They've had a medical emergency. They have a company that's closed down. And unfortunately, it's true that most startups do not last beyond one. They don't, 70% of them don't last to raise $1 million. And a lot of these fail before that. So it's a pretty grim situation for seed stage startups these days. But you can help do something about it. The first thing is, even if you're not an investor, you can support your local startups. As Elizabeth mentioned, the Ferguson Library hosts 1 Million Cups, which is a nationwide free program underwritten by the Kauffman Foundation to showcase startups. It is the first Wednesday of every month. It's early in the morning, 8 to 9, so it doesn't impede your job. It's virtual currently, and you'll meet 2 startups every month. It's your referrals, your introductions, and your connections that can help them. You don't need to be an investor to help a local startup. So that's one way that you can help a lot. The other way is to take immediate action after we finish this seminar. Email your congressman and your senators to terminate preferential tax treatment of carried interest for private equity and hedge funds. Capital gains for carried interest needs to reflect risk, like VCs at seed stage or Series A. It should not be a reward for low risk or risk-free growth equity income. And that's exactly what was created by the Dodd-Frank Act and which has been continued for the last 8 years, actually more. It's now more like 12 years since then. So those are the two ways you can help. I'm going to stop here. I know I've introduced a lot of nomenclature and we've gone through a lot of charts. So I really want to take questions from you about any part of this presentation. And, you know, if I can't answer the question, I'll get back to you by email and give you the answer.
So Brenda, I'd like to ask a question, if you will. So how do you see this trend in terms of venture capital moving next year and in future?
Yeah.
Like what are you forecasting?
Well, I mean, people much more skilled in the market, you know, that are in it every day as venture capitalists themselves have been very worried about the seed stage market. And hence you saw those very large venture capital firms like Andreessen and Greylock and Sequoia stepping up to the plate and raising these massive seed stage oriented funds. They don't want to cede the market to the private equity and hedge funds. They recognize that there's a problem. So that is, you know, it's in train. It's just late. Now, the other thing that's happening, and maybe there'll be some amelioration in the, you know, sort of rush to IPOs, is that Gary Gensler, who is the head of the SEC, has been investigating special purpose acquisition companies. They are a legal entity, but there's been some questionable investments made. And so the increased scrutiny on, they call them SPACs, I think may slow down some of the private equity and hedge fund activity to some degree as we go into 2022. The other thing, and I'm hoping against hope, that the carried interest will be changed for these PEs and hedge funds will be changed over to income. Somebody called Joe Manchin, who was an author of a bill to stop that, would be a great supporter of that happening. So I'm hoping it will get reinserted into the funding of the Build Back Better bill as we go through next week and the negotiations in the Senate. So I guess there's so many variables right now. It's hard to say that seed is going to come back strong next year. I'd like to think that maybe in 2 years, the worst of the excesses in this market will have been overcome. But in the meantime, it's going to be a very rough 2 years for any company that needs to raise seed stage funding. And as I say, if you don't have revenues, you know, it's probably going to be a hard slog. I don't know, that sort of over answered your question, maybe.
No, thank you. That was really informative. I'm not sure we have any other questions, but maybe this is a nice note to end on. You've talked about the present, the current conditions, and spoken a little bit about what the future holds in this area. So I want to thank you so much for your time and for all the information that you've shared with us. Again, if you don't mind, we will be hosting this video on our YouTube channel for a little while till, I guess, the information's outdated, I guess.
Great. No, that'd be great. Thank you very much. I appreciate it.